Welcome back. Escalating trade tensions with Canada, making for another choppy session on Wall Street today. While investors' flight to safety typically includes treasuries, my next guest says they should look at another option during times of uncertainty: high-grade munis. Craig Brandon is back. He's co-head of munis at Morgan Stanley Investment Management. And this is what the Japanese and the Koreans are doing. I mean, global investors really are looking to this U.S. asset class. Is that right?
They are. So a couple of weeks ago, I was in Japan and I was in Korea. And really, the way that institutional investors there view munis as, you're taking credit risk off the table. You're not giving up yield. You're not giving up duration. But you're going to an asset class that has, mostly double, AAA ratings, and it's just a much safer risk-off asset class.
Do we have to worry about a slowdown affecting, maybe not default risk? I don't think we're talking about that kind of event yet, but, a slowdown is, that's something you have to grapple with. I mean, these are toll revenues. There's lots of different sources that could see a little bit of a hit. Yeah,
so the slowdown, I have to weigh sort of the pluses and minuses of a slowdown. The minuses, there could be some credit risk, maybe a downgrade risk. Like I said, 71% of the index is triple and double A. So maybe you're going from a double A plus to a double A, which in reality is not that big a deal. But remember, in a slowdown, you might see rates falling, both the Fed and Treasury rates. And we are correlated to Treasuries. So what we tend to see are assets coming into munis in a lowering rate environment and going out in a higher rate environment. So, maybe you might see some slowdown in the economy, maybe affects tax revenues, toll revenues, things like that. But the way I look at it is if I see a gradual slowdown in the economy, you might see lower rates, which could bring assets into the muni market, which could help us outperform.
Right, because would you say its performance and just kind of the general environment compares with the last few years when rates were soaring? Because that was a really tough period for all bonds.
It was. So we definitely underperformed a little bit. With the flows you saw in 2022 when rates were rising, there was very poor performance. And then in 2023, when rates were falling a little, you saw the money coming back in, right? So we really are correlated to flows. We're correlated to rates. And, in a falling rate environment, we generally see positive flows and positive performance.
People are really kind of making light of the fact that Warren Buffett has this big position in treasuries, which a couple months ago you said, well, they're big, there's not a lot that they can buy. And now as we're sitting amidst one of the deepest sell-offs we've had in a few years in terms of the kind of seriousness and quickness of it, he seems to be sitting pretty. Now, he's not in munis, but I think that captures the sense that people have all of a sudden. They go, geez, maybe I should have or should now look at doing something like that.
Right. And what we're starting to see, I was talking to, my head of trading this morning, and we're starting to see some non-traditional buyers come back into munis. We've underperformed treasuries a little bit in through here year to date, and we're starting to be attractive versus corporates. If you look at munis on an after-tax basis, again, companies get the tax benefit against the 21% tax. We're starting to look cheap to treasuries. We're starting to look cheap to corporates. You're starting to see some of those crossover buyers come into munis. We look at ratios, right? So corporates trade at a spread to treasuries. Mm-hmm. Because we're tax exempt, we trade at a rate lower than treasuries. Mm-hmm. So we start to become attractive when our outright rate gets close to treasury rate. Yep. So in the long end, we're at about 90%. At a 90% rate, you start to see some of the other non-traditional buyers come in, the insurance companies, the hedge funds. We look attractive.
And we've been seeing corporate